Yeah, so generally tariffs are not good for economic growth because they are basically a tax on global trade as well as global consumption. So in the end, both the exporting as well as the importing country are of worse. So it's a negative for economic growth, and because companies' earnings profiles is largely also dependent on the macroeconomic cycle, it's a negative. We believe that it's going to have a negative impact on global growth, but especially also on US growth, because the US gross domestic product is made up more than 60% of US consumption. So if consumption is slowing down, that is a negative on the US economic development, and that is also going to impact the profitability of US companies, especially those that are closely connected to the US consumption. So the risk of a recession has clearly increased because if we are thinking about the current environment, it's actually a supply shock. Usually a recession, and this would be a very untypical recession because it would have been created by political decisions. Usually you have an increase in capacity before a recession. Then you have a slowdown in demand, which is causing overcapacity, and that is causing a slowdown in economic activity. But this time, this would be a supply shock because you are increasing the cost of supply. You would actually implicitly reduce supply to the economy, which would be a very untypical kind of a recession. So the risk has actually increased. We would consider the risk of a recession to be roughly 50% right now, so significantly higher than in a normal market environment. Usually you think like a recession probability is usually 20%, but right now with 50% probability that is significantly higher than on average. So with especially our strategy, we are very defensive investors, very conservative. So we focus on companies with a very strong competitive position, with a very good balance sheet, and a strong business model, strong competitive position against their peers. So the risk profile that we have in the fund is actually significantly lower than for average other equity funds. So the focus on dividends is actually creating cash flows to investors that are creating a sort of minimum cash flow return to investors, which is usually causing a lower volatility for equity income strategies, which our strategy has been significantly lower volatility than a global equity market. So in times of uncertainty, usually the strategy shows its strength. So for the fund, the DWS Top Dividend, we are mainly focusing on companies where we have a good combination of a solid dividend yield, but also dividend growth and a relatively low payout ratio. Why do we like a low payout ratio? It's mainly because in times of an earnings contraction, companies will still be able to pay a dividend out of their earnings cash flow. We couple that with a strong balance sheet. So in times of recession, for example, the risk that we just discussed, these companies might be able to complement their dividend payment from the balance sheet, i.e. they could borrow and could increase the debt on the balance sheet to supplement the dividend for 1 year or for maybe 2 years. But usually we want the companies to be able to pay their dividend from their operating cash flow. That gives us much more confidence that these dividends are sustainable and can be paid throughout a long period of time. In cyclical sectors, a lower payout ratio is much more important because the volatility of their earnings profile is much higher. So in a cyclical sector, you actually want to have a lower payout ratio than in a stable sector. So in a stable sector, you can have a payout ratio that is maybe 80% of profits. In a cyclical sector, you maybe want to have 50% because there's usually, in a recession, you could have an environment where earnings are falling by 50% and you could still be able to pay the dividend. So in a global equity portfolio nowadays, the United States has roughly 70% weight in a broad market index. For our fund, the DWS Top Dividend, our United States equity exposure is just 30%. So we are significantly lower exposed to the United States and are therefore higher exposed to other countries in Europe, for example, Germany, France, but also in Sweden and the United Kingdom. So we are significantly overweight other parts of the markets in Europe as well as in Asia. Furthermore, we have a relatively high position in cash. So we have 15% not invested in equities right now. Half of that would be invested in very short-term bonds, so it's actually a cash replacement, and the other half would be invested in gold ETCs. So we believe that still, despite the recent correction in equity markets, valuations are still quite high. So globally, equities should deliver a little bit lower returns than we've seen over the last 2 years. So we expect that, given the current valuation environment, you should rather expect mid-single-digit equity returns over the next couple of years, not double-digit returns. In an environment where you have lower returns, the importance of dividends increases again. So if you think about a dividend strategy like ours, our fund has a dividend yield income of roughly 3.4%. And if you assume a mid-single-digit return environment, half of your income is already made up for dividends. So the dependency on price returns is much slower. It's much lower in that environment than it has been in the past.